Hello, this is Gene Goldman, CIO and Director of Research for Cetera Investment Management. Welcome to the Cetera Market Briefing. What I'm going to do today is discuss 3 points. Number one, I'll talk about what happened to the markets yesterday. Number two, what caused a sell-off yesterday. And number three, what's our perspective on the markets going forward. So yesterday we saw one of the worst days in the markets for 2019. The S&P 500 and the Dow Jones Industrial Average both lost 2.4%. The Nasdaq was down 3%. We saw 9 out of 11 sectors in the S&P 500 were negative. The only positives were utilities and real estate. It was clearly a risk-off environment. The 10-year Treasury, the yield fell to 2.4%, lowest for 2019. So what caused markets to sell off yesterday? Clearly, it was concerns about the trade war being resolved. Yes, last week and over the weekend, there was news from both the US and Chinese side where the US side announced that they would increase tariffs on $200 billion of Chinese goods and potentially add tariffs to the remaining $300 billion of goods. The Chinese side said they would retaliate with tariffs on their own. Clearly, this weighed on investors' minds. Most importantly, going forward, what's our perspective on the markets? Well, think about 2019. 2019, the start to the markets, we've had one of the best starts in such a long time. The markets have priced in a dovish Fed, priced in better economic data, and they've also priced in a trade war being resolved fairly soon. With all this said, though, we continue to believe the most likely scenario going forward is continued market volatility. We've been saying this for a long time. As investors grapple with both positive news and risks in the market, market volatility will be elevated. Market swings will take place going forward. So what are some of the risks that we see in the market? Well, first of all, we continue to believe that what is the next catalyst? Markets have seemingly priced in a dovish Fed, a trade war being resolved, and good economic data. But what's the next catalyst? We're looking for that. Second of all, as a risk in the market is valuations. The forward PE on the S&P 500 is about 17.5. This is prior to yesterday's decline. Today it's about 16.8. Valuations are a little bit better, but they still are elevated relative to history. And the third point is that some of the economic data we've been seeing recently has weakened, especially in the manufacturing side and the services side. So those are the risks. The positives, there are lots of positives out there. First of all, we are in a very low interest rate environment. Second of all, the employment, labor market is very strong. We are at a 50-year low in the unemployment rate. Payrolls continue to be very strong. This is very good for the economy. And third of all, first quarter corporate earnings were much better than feared. Going to the quarter, analysts had expected earnings to decline 3.9% for the first quarter. You're looking at a positive 1% for earnings for the first quarter. Great news. But again, our thesis, our expectation going forward is that market volatility will pick up as investors grapple with some of these risks I talked about, and they also grapple with all these positives. So again, we do believe the trade war will be resolved soon. There's many reasons why the trade war will be resolved. But most importantly, we foresee volatility picking up. The most important point I want to say is, listen, definitely work with your financial advisors to understand, to navigate this increasing market volatility. They have experience, they've seen this volatility before. Again, this has been Gene Goldman, CIO and Director of Research for Cetera Investment Management. Thank you for listening today.